Learmonth, Caledonia Mining's CFO, and also Director. All right, just by way of overview, and I realise some of you are familiar with this story, but some aren't, so if you don't mind, I do need to cover all the bases. Our main asset is, our only asset now, having cleaned up our corporate structure, is the Blanket gold mine in Zimbabwe, of which we own 49%. That means that we're fully compliant with local ownership requirements, which is probably the single biggest deterrent for foreign investors in Zimbabwe. So we comply with that completely, and we think we've de-risked ourselves quite completely. Last year we produced just under 42,000 ounces. This year we'll produce another 42,000 ounces. And then, as I'll explain to you in a moment, the production trajectory increases 50,000 ounces in 2016 up to about 65, and then targeting 80,000 ounces by 2020. It's somewhat low cost, so the on-mine cash cost is in the mid-650s. The all-in sustaining cost, so that includes G&A and sustaining capex, is about $1,000 an ounce, and we do expect to bring that down quite sharply as we increase production, but more on that in a moment. And about this time last year, we announced a growth, a reinvestment program. So we're putting $70 million into the business over the next 6 years or so. We've just coming to the end of the first year of that investment program. So this year we'll have spent about $16 million. And we think that pretty much we're through the worst, through the toughest year. But again, I'll come on to that in a bit more detail in a moment. We've got a strong cash position. We've got 22 million Canadian dollars in cash sitting outside the country. Part of that we're going to put back into Blanket in the next sort of few weeks because the gold price has been slightly lower than we expect. But we've kept a strong cash position specifically to cater for that eventuality. So we are fully funded. And as you'll see in a moment, we're on a very lowly rated. We're on a very low PE ratio, very high dividend yield. And I thought it was a high dividend yield until I had a chance to look in the Sunday Times on the flight over last night, and I saw Anglo American's dividend yield and Glencore's dividend yield. And now I don't feel quite so confident in those statements anymore, I'm afraid. But never mind. We do pay a dividend, 1.5 cents a quarter, 6 Canadian cents for the year. And I think the difference between us, Glencore and Anglo American, is that we've got the cash in the bank to pay the dividend. So the dividend is quite secure. Because we've got the cash to pay it. Okay, these are the value metrics. I think these are somewhat irrelevant now, actually, given what's happening in the market, certainly for the majors. We're on a laughably low PE ratio compared to the other gold producers, and we're on as I mentioned, a dividend yield which I thought was quite high at sort of 7% or so. But sort of comparing it to some of the other miners which have sort of significant difficulties, perhaps that's not so low. But I think the difference really comes to the. Sorry? The yield. Our yield 7.7%. Yes. That's very good indeed. Well, when you compare yourself to Glencore at 13 or Anglo at 10, perhaps it doesn't look so good, but it's fine. We'd like to get. We'll come back to the dividend in a moment. Oh yeah. We're one of the very few gold companies that does pay a dividend, and we understand the importance of the dividend to investors, and it's something that we're very keen to lock in place. But perhaps more on that a bit later. And the low rating has got nothing to do with the business. I've already told you that our all-in cost per ounce is sort of about $1,000, perhaps a bit less. If you look at our cost per ounce compared to the other African gold producers, I mean, we're there or thereabouts. We're better than an awful lot of them, and there aren't very many producers that have got a lower cost than we do. I think significantly, as we implement our growth plan, we do expect that all-in sustaining cost to fall away very sharply. So this coming year, 2016, we're looking at an all-in sustaining cost of below $900 an ounce. 2018, we're looking at below $750. And that genuinely means that we can sustain a gold price of $750 an ounce and still wash our faces. As the business goes forwards thereafter, with increased production, we can comfortably live well below $700 an ounce. So, this business, we're building a very, very sustainable business. And really, the reason why we got such a low rating really comes down to people's concern about Zimbabwe. And so, I'll spend as much time as we like talking about Zimbabwe. Clearly, I'd like to talk about, how we're going to increase production and what we're going to do. But really, experience suggests that for investors, it's the sort of Zimbabwe skunk factor that scares people off. So there's basically about five concerns that people have in their minds relating to Zimbabwe. The first is political stability. So people have in their idea, this mind that Zimbabwe is going to explode into political violence. We go to Zimbabwe often. I was there last week. I was there the week before. I'm going to be there next week. Sure, it's got some. You may not like the government, but by no means is it unstable. ZANU-PF has been running the country for better or for worse since 1980. There is some political jockeying taking place right now as Robert Mugabe potentially approaches an event. But we don't see that spilling over into violence on the streets. There just isn't the appetite in Zimbabwe for the sort of explosive political action that you probably much more likely to take place in South Africa. So we feel safe in Zimbabwe. We walk the streets in Zimbabwe. We don't feel at all threatened with what's going on there. Indigenisation is the single biggest concern for investors, and the regulations are that 51% of every single business has to be owned by local people. We're one of, as far as I know, 2 mining companies that comply completely with indigenisation in Zimbabwe. We implemented a series of transactions in 2012, so this isn't something we just knocked up last week to tell folks in London. We've lived this deal for sort of 2 and a bit years now. But what we did is we sold 41% to 10% went to the workers, 10% went to the local community, 16% went to a government fund, and then we donated 10% to the community, and 15% went to a local investor group. So no one's got a controlling interest. We've got the single biggest shareholder block. And actually having our workers in there for 10% and the community in there for 10%, we think has gone a long way towards buying us some friends locally. And we do get tremendous support from our workers, from the community, and government knows that actually we're probably the only mining company that's investing significantly in the country, and that's changed our dialogue with the government enormously. Inflation is somewhat outdated now, but people still have this idea about the inflationary environment in Zimbabwe. At its worst, prices were doubling every afternoon, and it just became impossible. There were new numbers being billions, trillions, quadrillions, quintillions, sextillions. I mean, there were zeros and zeros stretching from here to infinity for the inflation rate. That all stopped in 2009. The Zimbabwe dollar just completely disappeared. It's no longer legal tender, and everything we do in Zimbabwe is now denominated in US dollars. Which, for better or for worse, kind of means that we don't get the benefit of any sort of deflation, any sort of exchange rate movements from our input costs. But actually, working in US dollars is a fairly level playing field, and it's something we're very comfortable with. On the ground, we actually face a mildly deflationary environment as some of our input costs are going down. And people say, oh, Zim's a bust, it's a poor country, the infrastructure, they can't be up to scratch, you can't possibly operate there. Again, not true. Most of the infrastructure in Zimbabwe was put in place by the British and the Rhodesians in the 50s, 60s. And it's fit for purpose, it works fine. The roads are fine, the airports are fine, we've got everything we need to run the mine successfully, and we wouldn't be able to achieve the costs that we have achieved if the infrastructure wasn't fit for purpose. Standout feature in Zimbabwe is the quality of the workforce. Absolutely stunningly good. They're highly educated, highly trained. They do O-levels and A-levels. And every single worker at the mine is an indigenous Zimbabwean. And again, we wouldn't be able to achieve what we've done if we were employing local idiots who didn't know a widget from something else. I mean, so quality of the workforce is outstandingly good. And then people grudgingly say, okay, that might all be true, but you'll never get the money out of the country. Again, not true. Every single one of those 22 million Canadian dollars sitting outside the country has come from Zimbabwe. And we take the money out by way of a monthly management fee, which goes from Zimbabwe to South Africa. We've got a procurement margin in South Africa, and we have managed to take out very significant dividend flows out of the mine. So we've never had difficulty getting money out of the country. And actually, it's much easier to navigate the Zimbabwean exchange control environment than the South African one. Just some background information, just some sort of simple sort of capital structure, 52 million shares, currently at 78 Canadian cents. Market cap's about 40 million Canadian dollars. I think what's perhaps noteworthy is the share price graph. So we're the blue line, and the orangey goldy line, that's the GDXJ, which is a Van Eck managed hedge fund of junior gold producers. And I think what's significant is that our share price from about sort of this time last year actually managed to gap up quite significantly. And I think that's because people began to understand the revised investment plan that we put out about this time last year. They began to see that we're going to grow the business, we're going to double production, we're going to get our cash costs down, and it's all internally funded. So unlike most junior gold companies that constantly need sort of top-ups of capital, we were fully funded, and we paid a dividend to boot. The sharp correction here, that took place on that awful Friday when the gold price collapsed. And I think the immediate market reaction was that in a lower gold price environment, we as a dividend-paying company might have to reconsider our dividend policy. And so that's why we think our share price, and actually there's one other company as well, Pan-African, it's a South African gold producer, they also pay a dividend, and their share price also fell significantly on that day, as did ours. Whereas for the rest of the guys, because they don't pay dividends anyway, you know, it just means they don't make as much money, they don't pay as much, they don't pay anything out, so there was no dividend to worry about. Since then, our share price has somewhat modestly outperformed the GDXJ, particularly in the last sort of short time. And what we expect to see as we move into 2016, and as people become more confident in the delivery, so increasing production, falling costs, better cash generation, we would expect once more to see our share price outperform compared to the GDXJ. Management, that's myself and Steve Curtis, our chief executive. We've got just less than 1% of the company. Alan Gray is one of South Africa's biggest institutional fund managers. They bought about 13% in the market about 18 months ago. And then we've got about 42% of US retail investors. And of the 32% that's shown as Canadian investors, we actually think a significant proportion of those are not Canadians. They just hold through Canadian street names. Resources, we've got about 7.4 million tonnes. So that's about 500,000 ounces of M&I resources. Canadian regulations don't allow us to do the maths, but if you did the maths, you'd find we've got about 550,000 ounces of inferred resource. About this time, in May, we did a significant resource upgrade, so we moved about 20%. We moved a significant dollop from inferred up to M&I. We're working on a new resource upgrade at the moment. So we've pretty much doubled the amount of deep drilling activity that we're doing on the mine. And we do expect that on a fairly regular basis, perhaps every 6 months or so, to put out either a resource upgrade or hopefully also an incremental inventory. Right, so what you see here is a couple of graphs, a bit complex really. The top one shows how we managed to increase production. So the mine stopped in 2009. We increased production up to about mid-2012. And then since then, it's been a fairly sorry story of production slipping down. And the bottom graph kind of explains it, but I'll tell you what the problem was. The problem was that the bars here show the tons milled, tons mined. And just because of logistical constraints underground, we just physically couldn't move more stuff underground. We couldn't get more ore out of the ground. So we were capped at about 100,000 ounces a quarter. And the thing that did the damage is the grade. And the grade fell from about 4.5 grams a ton, which was abnormally high, as we were going through some high-grade areas. The grade just sort of slided away down to about 3.2 grams a ton. And given the fact we didn't have the ability to increase tonnage, that meant that production slithered away as well. So recognizing that over the course of last year, we realized that our problem really was that we had the logistical constraint. We couldn't move more material. And also we needed to get deeper. We need to get into the deeper ore bodies and access higher grade material. So about this time last year, we came up with a revised investment plan, which I'm going to talk about in a moment. But I think what is significant is this little bar here, the red one. That's not red by mistake. That's red deliberately. That's the tons milled in the last quarter, quarter 3. And you can see it's significantly higher than the tons milled in previous quarters, and that reflects the very first sign that the revised investment plan is beginning to bear fruit. Because having completed an underground tramming loop, a sort of circular tramming loop, it now means for the first time we're not so constrained in our ability to move material. And so we're able to accommodate the lower grade by moving more tons, mining more tons, milling more tons. And I think that's the first sign of what's going to come over the coming quarters as we implement the revised investment plan. So, 3 aspects to the revised investment plan. This is the one we've done. So that's the tramming loop on 22 level, which we completed in June, and we're beginning to see the first fruits of that. We've completed a subvertical shaft in July, and we've nearly completed equipping that. And towards the end of this year, early January, we'll do horizontal development, and by mid-quarter 1, 2016, we expect to see incremental production coming out of that. But the big thing that we're doing is we're sinking a brand new central shaft from surface down to just below 1,000 meters below surface, a big 6 meter diameter shaft. That's costing about $23 million. It's already well advanced, and that is what's going to deliver the significant increase in production from about mid-2018 onwards. So an analyst today told me this diagrammatic looks as though it was put together by a 10-year-old, for which case I'm sorry about that. Perhaps we'll try and make it better. What you see here is a long section of the mining area. It's about 3 kilometers from left to right. We operate a series of near vertical ore bodies, so you've got Lima on the left and Jethro on the right. The existing infrastructure shown in green, so it's what we call the number 4 shaft, which goes from surface down to about 750 meters, a horizontal development on 3 levels. This mine's been running for 100 years, over 100 years. And so pretty much we're getting to the end of the resource base above 750 meters. So 750 meters is the bottom level of operation. And so what we're doing to address that is, this is the number 6 winds, this little thing in yellow, which goes from 750 meters down to that level there, and then we'll deepen it later. And that will provide early access starting next year into these ore bodies here. Then the big story is the central shaft from surface down to just below 1,000 meters, 1,000 meters, and then horizontal development in two directions. And you can see that completely opens up the mining area. And that will address the existing resources that were shown here. These sort of grey areas, those are further exploration areas. So the mine plan that we've got in place and the production profile that we put into the market is only based on the existing resource base. We don't make any, and we couldn't do this, we don't make any sort of estimates as to what we may find for these downward ore body extensions here. That's news for another day. That's how we expect gold production to play out over the next few years. So 2014, we did 42,000. This year, 2015, we'll do about 42,000. Then you can see the fairly significant increase to 50,000, 65, and then on up to 80,000 ounces. How are we going to pay for the money? How are we going to pay for this expansion project? We had said it was $70 million. Actually, that's come down a wee bit. In 2016, this time last year, we were expecting to spend about $17 million next year because of some sort of clever procurement and the fact we buy a lot of our stuff in South Africa where things are available at knockdown prices. Next year, we'll probably only spend about $14 million. And that $14 million actually includes some new stuff that wasn't included in the original plan anyway. So, as I say, I think we're through the worst of it now in that we've spent, this has been the difficult year where the capex has been high and the cash generation has been low. All of this will be funded from either cash generation for the mine and our existing cash resources, $22 million sitting offshore. We've deliberately maintained a very robust cash position to protect ourselves from just the situation that's playing out now where the gold price is falling, and we don't want to put ourselves in the position where we need to run out and raise more money, because that would be very tough. So just sort of finishing up on this revised investment plan. This is by no means a stretch budget. We've never had to go back and ask the mine planners, the mine engineers to reconfigure their plans to do stuff more quickly or more cheaply. Everything we say we're going to do, we've achieved on the shafts that we've already sunk at the mine, and with the same costings. And we're in a zero inflation environment. It's fully funded, so we don't need to raise debt or equity to fund this. And by fully funded, that means that as a group, we can continue to fund this project. Sure, we may need to put a bit of money back from Canada back into Zimbabwe, but we'd much rather have the money out of Zimbabwe in the first place rather than leave it sitting there. It's low cost and it's high return, and that really comes down to the fact that we're using our own labour force in Zimbabwe. which is highly efficient, highly skilled, and very experienced. We don't fly in sort of Australians who work for 2 weeks, then go home for 2 weeks and upset the locals. And don't forget, this whole project is taking place in our back garden. This is on a mine that we've been operating since 2008. The mine itself has been running since 1906. This isn't some new project in Ouagadougou that takes 2 weeks to get there. All the infrastructure that we need, all the services, all the skills, all the equipment is sitting 800 meters away from where this activity is taking place. Just to sort of put some numbers on this is Edison research. Edison's just put something out more in the last day or so, which is available on our website and their website. But this basically, what you see on this table is this shows how, as production increases to sort of 50,000, 64,000 in 2016, 2017, how they expect the earnings per share to increase and how we expect our operating cash flow to increase. And the benefit that we're getting is we're producing more gold, we're selling more ounces, but the average cost of production goes down because 75% of the costs are fixed. And so as you produce more ounces, those fixed costs are spread over more ounces. Our marginal cost for every extra ounce is about $250 an ounce. Okay, so even at the current gold price, every extra ounce we produce, we're banking $750 an ounce. Dividends, we pay a dividend. We've been paying a dividend for quite some time now. It's been stuck at 6 Canadian cents a share. We're absolutely committed to maintaining that dividend. We know it's important to shareholders. We think it's an important discipline for management. The dividend costs us about 3 million Canadian dollars a year. We've got 22 in the bank, so it's well covered by our cash resources. So, I mean, what are you going to see going forwards? We've finished the tramming loop on budget, on time, mid-2015. The benefits of that are beginning to flow through. In Q1 2016, you'll start to see production increasing as production comes from the number 6 wins. We expect to complete the central shaft in 2018, early 2018, and production starting very quickly after that. So those are the milestones that you can look out for. If you want to get research, you can get research from Edison on their website. Our PR people, Blytheway, are sitting towards the back. Camilla was at the mine last Monday, Tuesday, and so she can tell you anything you want to know about the mine. She's been there, she's seen it, she's verified the fact it exists, and it operates as we say it does. So, you know, with that, I'll take some questions. We have 8 minutes or so for questions.
Thank you very much, Mark. If you have any questions, again, please raise your hand. I'll wait for Peter or Chris to come over. I'll kick off if I may. You mentioned. You spent quite a long time talking about country risk and perception of country risk. And I was thinking back, we've been speaking 3.5, 4 years or so. And over the period of that time, I can't think off the top of my head of anything that's been a political or a country risk unique to Zimbabwe, which has affected you, the mine, the operation. Is that fair to say? Or
absolutely. So when people say, oh, the country risk, I say, what are you worried about? What's the country risk you're worried about? Are you worried about the fact we're going to be nationalised? No, we're not going to be nationalised because we fully comply with local ownership requirements, and that's not going to happen. And actually, the Zim government has studiously steered away from nationalisation. What else are you worried about? You're worried about the army coming and taking over the asset? Not likely, with the workers having 10% and the community having 10%. You're worried about electricity. I ask people to. What are you actually worried about in Zimbabwe? And they always say, "Oh, it's just a difficult, just a difficult, dangerous place." Yeah. Well, we think it's actually a much more stable, conducive environment to work than certainly South Africa, which is where we live for our pains. So.
I've just looked in my diary, and I happen to be a shareholder of Caledonia.
Very good.
I bought them at 0.425. Is that right? Less than a halfpenny.
Yeah, that would. Yeah, but that we had a share consolidation, a 10 for 1. No, that would be 4.25p. Okay, and now we're 42 pence. So we've kind of stayed. I think for our share price to stay, I don't. We must have bought sort of perhaps over 2 years ago. So I think for a gold producer's share price to have stayed.
March this year.
No, that's.
That's about 42 pence.
42 pence, yeah. So our share price has stayed stable since March this year. Yeah.
And could you explain, sorry Richard, in terms of indigenisation, you said 51% is owned by locals or by the state. Practically, what does that mean in terms of making decisions or operationally or
can you just go back
how much dialogue is there?
Can you just go back to the presentation? There's just a little slide right at the end which I didn't show you, which I can. Okay, this is the ownership structure of the business. So this is the listed vehicle that we can all buy and trade in. That's the beast at the bottom that makes all the money. This is the ownership structure. So community 10%, government 16, local partners 15, and employees 10. Nothing that I'm going to say now is hidden. So all of this is publicly available. It's just that we tend from time to time not to put this up in big flashing red lights. The board of Blanket is an 8-man board. We have 4 nominees. These guys have 1 each. So it's a 4 and 4 board. We can nominate the chairman. And so the chairman has the casting vote. We have a management agreement. So we actually make all the day-to-day decisions. Clearly the strategy is framed by the board, but we can control the board. And if push came to shove, the employees, that's an employee trust, which would be highly unusual for it to vote in a way that we don't effectively direct. None of this is something we'd like to put in red lights or in big red letters on a press release, but those are the facts. And the fact that we continue to control the business underpins the reason why we can continue to consolidate it. And the SEC and the Canadian regulator are crawled all over the fact, how can we continue to consolidate a business where we've only got 49%, because that we've explained to them these control mechanisms that are in place. So absolutely control it. In terms of the dividend stream, Blanket pays a $10 million dividend. We get $4.9 million as a 49% shareholder. And then we collect 80% of the dividend stream that flows to these guys because we extended them a loan so they could buy the shares. So we continue after tax to collect about 78 to 80% of the dividend distributions. That's after withholding taxes. And so actually it really doesn't change our cash take at all. At all.
And any questions? Gentleman here, please, Peter.
How deep have you dug the central shaft so far, and what does it look like in terms of how progress is going? Will it become more difficult as you get deeper, or? Well,
you don't ask me because I'm ugly. You'll have much more fun talking to Camilla about it afterwards. She was looking at this enormous hole last Monday, Tuesday. We're currently down to, I think, just under 30 metres. The first 30 metres is the slowest because we've got to put in place the shaft and the barrel, and we've got to concrete it, and so that's where all the infrastructure takes place. I think that's actually been completed more or less now, perhaps the last day or so, and then we expect to get down to 90 metres by the end of the year, and then after that it's a straightforward decline at 1.8 metres per day. So the first 30 metres or so are the hardest, and then after that it really is just straight down. Keep digging, guys. Only a kilometre to go. So you'll see the rate of it's bang on plan. So you might think, only 30 metres after sort of 9 months. That's not very impressive, but the rate does pick up once you get into the proper sinking phase and all the infrastructure's in place.
What's the diameter?
6 metres.
6
so
metres.
It's pretty much from me to you.
Okay.
I mean, this is a damn big hole. Eh? It is huge. It compares to those big shafts that you get at the big mines in South Africa. This is a proper shaft. This isn't some sort of little Zimbo 2 metre by 4 metre shaft. This is a proper shaft.
And how far away from the existing
800
shaft?
metres. 800 metres. Yeah. Very
Okay.
close.
Okay,
Very close. There are some. I mean, we've got some pictures on the website. You'll find some video footage. If you hunt on the internet, you'll find some sort of video footage. Some of it's in German, but it doesn't matter. But ask Camilla. She was there. She's seen it. You know, she was there. She was peering over the edge. You have to pull her back.
Any other questions? We've got a chance for one last if we have any questions in the room. Okay, well, Mark, thank you very much indeed.
Thank you.
Thank you.
Bye.